Good morning, friends. This is another video. Uh, something has been bothering me for some time, which is that technical analysis is kind of the most abused field for uh, in the times that we are living in. Given the number of courses that are getting run, given all kinds of people uh, reading 3 to 5 books and calling themselves analysts. Now, the issue is that most people have it wrong, which means, uh, they are thinking technical analysis by itself is going to make you money. And having been, a technical analyst for the better part of my life, I, after 20 years, would like to say that technical analysis on its own means nothing. What is the reason? The reason is the sort of theories people are getting sold, the sort of system uh, trading which people are getting sold. By that I mean, you make a software which gives you a green arrow, you buy, gives you a red arrow, you sell, and that sort of crappy systems which just run up commissions for brokers. And in a range bound market, these sort of things fall on their face. So basically, the tools people are selling are all bull market or bear market or trending market tools. Nobody is really giving you tools for a sideways market. Well, the way I have started to evolve my technical analysis tools is that if a price is coming down, it could be an index or it could be a stock, I have started to look for opportunity in that instrument, which means that while lots of technical analysts will tell you that if a price is coming down, you sell into it. If a price is going up, you buy into it. But in a sideways market, what will happen is that if something comes down for 5 sessions, often you will start to see some upside happening on that instrument. Now, obviously, you have to keep in mind the trend. But if you have identified an uptrend, and the way to identify uptrends is if the price is trading above 20 and 50-day moving averages, we would say that the price is in an uptrend and the averages should be upward sloping. Vice versa for a downtrend. So, once something which has been in a strong trend starts to correct, we are interested in buying into declines in that instrument. So, if something declines for 5 days, you don't just start to go short, but you are looking for opportunity to buy. Like, for example, uh, for 24th of Feb 2020, I am interested in buying the decline on the Nifty at about 11 930 950 for several stocks which are strong and have started to correct. I am interested in buying the decline in those stocks. So once you start to see decline as an opportunity to buy and rallies as opportunities to sell, plus add the triggers or the macro events which could lead to that sort of an upside. In an earlier video, I have explained how events can be added to a technical position. You will be able to increase the effectiveness of your technical strategies. Okay, a lot of people trade pivots based on S1 and R1. Okay, because 67% of the time S1 and R1 uh, contain the price on any given day. But again, even there, if your R1 is accompanied by some sort of news, it could be a positive news, the market will give you a much better risk reward and will come crashing down from those levels. Again, in a sideways market, R1, if it is at the upside boundary, which is the larger boundary of the range, you'll get a much better trade. Similarly, S1 plus positive or negative news, sometimes negative is better. Like the Iran issue, on the second day when the market went up, it actually opened lower and then started to go rocketing up. So, what I am basically trying to say is that do not be in a trend following mode all the time. If the market is sideways, you have to change your perspective with which you are looking at declines or rallies. In those sort of circumstances, do not be eager to buy into rallies or sell into declines because the market is not giving you great follow through. So, since we look like we are going to be range bound for a long time, I would not think that the opportunity to trade trends is going to be there for a while. We all have seen, the way at 12,300, 350, everybody starts to speak of 13,000. We have all seen that at 12,000, 11,950, everybody starts to speak of, 11,400, 11,200. So that sort of extrapolation is valid only 20% of the time. 80% of the time, declines are opportunity to buy and rallies are opportunity to sell. And if you have this sort of a view and your plan is consistent with this kind of a view, you would have a much easier time in this kind of market. And that is the reason just pure technical analysis does not work unless you know the phase of the market, unless you can combine news flows with it, unless you know the approximate levels, the boundaries where you have to act. In a trending market, if I have to buy an S1, I would buy when the price reaches 20 DMA or 50 DMA, and from there I would like to buy because some sort of trend is behind me. Again, I have described what kind of charts you have to look at. Look for charts which start from lower left hand corner to upper right hand corner for an uptrend, and look for charts which start from upper left hand corner going to lower right hand corner for a downtrend. But even in trends, the ideal trade location is when the price comes against the trend, and then you are trying to take advantage of the moving average locations from where the price can turn, as I described, the 20 and the 50-day moving average. So keep this in mind. Technical analysis is not a holy grail, and if you are looking at very intraday type levels, those levels are not set in stone. They will often get broken. Yeah, you can make your 10-15 points on the Nifty, but intraday levels are quite ineffective unless you marry intraday levels with some sort of weekly or daily kind of zones. You will not find it effective. For example, at 11, 9:30, 9:50, which is a kind of a weekly level, if I start to get my S1 there on an intraday basis, that makes my strategy much more effective. Similarly, at 12,000, you know, uh, 240, 250, which is a weekly level, if I get my R1 there, things will become much more effective. On any stock as well, if there are places from where the stock has bounced back earlier, say there is some 20-day moving average or 50-day moving average plus an S1 which is there, then I will get much better movement. So try to do a multi time frame analysis so that your levels start to work much better. The problem is not with technical analysis. The problem often is with, you know, half learned technical analysis. So that should be it for the day. Ask me questions in the comments, and uh, if you have understood what I am trying to put across, as you grow in life, from being a technical analysis jihadist, you become more of a generalist because often what works in life is a more general approach of getting into and out of trades than just uh, doing one thing and one thing alone, because the effectiveness or the success rate improves when you use two or three methodologies together. That should be it. Take care and enjoy your weekend, and always protect your capital.